Welcome to Financial Intelligence. In this video, I want to talk about US Treasury bonds and how inflation can impact these bonds. I've decided to split this video into three segments. In the first segment, I'm going to talk about what US Treasury bonds are, and in the second segment, I'm going to talk about inflation and how it can impact US bonds. And finally, I'm going to show you that you probably own US bonds indirectly already, although you might not be aware of it. If you like the type of content that I provide, subscribe to this channel and give this video a thumbs up, and also hit the notification bell so that you don't miss any of my future videos. Part 1. US Treasury bonds. US Treasury bonds are debt securities issued by the US government. Therefore, whenever you are buying US bonds, you are lending money to the US government. These bonds are issued by the US Department of the Treasury to fund the operations of the US government. This is how the US bonds work. As shown in this picture, first, investors would lend money to the government by paying a principal to purchase the US bonds. Second, the government pays the bondholder semi-annual coupons, which are based on a fixed interest rate during the lending period. And third, after the end of the lending period, when the bond matures, the government returns the principal back to the bondholder. The government gets to use your money during that period and compensates you by paying interest every 6 months. As you can imagine, the yield or return on your investment as a bondholder is very much dependent on the coupon rate or the interest payments you receive during your investment period. A higher coupon rate is more desirable as it increases the cumulative payments that you would receive by investing in US bonds. Therefore, the simplest way of evaluating the yield or return on investment for US bonds is to look at their coupon rates. Note that there are multiple ways of defining yields for US bonds, and some are more complicated than the others. But for the sake of this analysis, we are just going to stick with this simple definition. At the time of recording this video, the yield rate for 10-year US Treasury bonds is somewhere around 1.5%, meaning that when you lend the US government $100, you will receive $1.50 each year for the next 10 years. At the end of the 10th year, you will get back your principal investment, which was $100. The question we should ask is this a good investment? And the answer is no. These are some crazy low yield rates. To appreciate how low these rates are, let's take a look at the inflation rate in the US. Part 2. Inflation in the US. Inflation is the general increase in price levels. Alternatively, inflation is defined as the decline in the purchasing power of the currency over time. In other words, in an inflationary environment, the purchasing power of the money that you have today is going to be lower next year. Note that inflation is a bond's worst enemy. That's because inflation erodes the purchasing power of a bond's future interest payments. US bonds have fixed coupon payments, therefore the amount of interest that you'll receive will not change over time even when inflation goes up. The average US inflation rate during the past few years has been somewhere around 3% according to the Consumer Price Index, or the CPI for short, posted on the US Bureau of Labor Statistics website. An inflation rate of 3% means that every year the dollar is losing 3% of its purchasing power. That is to say, today's $100 is going to be able to buy you only $97 worth of goods next year. Therefore, the real value of your $100 is going to be $3 lower next year compared to this year, despite the fact that its nominal value is still going to be $100. Now, it would be interesting to layer in this 3% annual decline in the purchasing power of your money on top of the previous chart. If you invest your $100 in US bonds, the government will pay you $1.50 annually in the form of interest rates. On the other hand, your $100 principal is going to lose 3% of its value to inflation. Therefore, in aggregate, your principal is going to lose $1.50 of its value every year. The bottom line is that under current circumstances where US bond yields are below the inflation rate, investing in US bonds is a crazy idea. US bond yields shown in green on this chart have been steadily dropping over the past 35 years. Also note that on this chart, the red line shows the Consumer Price Index, or the CPI, which is a proxy for measuring the inflation rate in the United States. As we discussed earlier, today the 10-year US Treasury yield is below the inflation rate, meaning that your US bond investments are actually losing value over time. Things might change in the future, but at this moment, investing in the US bonds is not a great idea. Note that this was not the case back in the day when US bondholders would actually make decent returns because US bond yields were higher than the inflation rate. How fast you will lose money on US bonds is going to depend on the gap between their yield and the inflation rate. Part 3. You already own US bonds. Well, you might argue that I have not invested in US bonds, so why do I care? The answer is you probably indirectly own US bonds through mutual funds and ETFs you have invested in. For example, if you have a 401k account and you are using their default investment plans, which are usually target date funds, you definitely own US bonds. Target date funds are mutual funds or ETFs structured to grow assets for individuals who plan to retire at a certain time in the future, and hence the name target date. For example, if you are planning to retire in 2040, you could invest in 2040 target date funds, which are designed to meet the capital needs of investors who want to retire in that year. These funds always allocate a percentage of their assets to US bonds. Therefore, if you are investing in target date funds, you are indirectly investing in US bonds. Note that you do not have to stick with your default 401k investment plans. You can always choose your investment plans such that they deliberately exclude US bonds. My suggestion is that instead of using the default plans offered to you by your 401k plan provider, you should take control of your account's asset allocation. Make sure that the ETFs and mutual funds that you invest in do not allocate a large amount of their assets to US bonds. I hope that you liked this video. If you have any recommendation or suggestion, please add them in the comment section below. Don't forget to subscribe to this channel and like this video, and also hit the notification bell so that you don't miss any of my future videos. Thank you and take care.